Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm here with the first weekly economic review of the month of September. The summer is nearing an end, but markets and the economy don't sleep. So let's see what happened this week at the close on Thursday. So as you can see on the chart here, absolutely nothing is red. So a very positive week across the board. Bonds were up on the week. The long index up 1.9%, bringing the returns year to date in positive territory. So good news here for anyone who has a balanced portfolio. Equities, good news this week. The markets continue to price a very optimistic scenario. We remain slightly careful in our views. We think that the odds of a soft landing are likely much lower than what is being priced here in the markets, and also what we see in the consensus of economists. But again, we may be wrong, but history tells us that when you're at the end of the hiking cycle, you tend to see this optimism gain the markets, gain the news flow, and then after that reality sets in, because when you have such a strong accumulation of tightening of monetary policy, there are some economic damage that follows that. 2023 by the end of this year, or 2024 throughout the year, should be a bit more volatile on the economic front than what is expected right now. But so far so good. Interesting to see the TSX rebounding with some verve this week by 2.4%. Technology rebounding because rates are a bit lower, but this week we didn't notice that on one day we had the lowest volume of any day in 2023 this year on the S&P 500 on an up day. So does that mean that it's a false signal? We'll see when September starts. Usually people come back to work. You tend to have a clearer signals and a clearer direction. But it was a positive week. Let's enjoy it. And the price of oil up by close to 5% on the week. Canadian dollar up, euro up, price of gold higher. So something for everyone here. Now, I may seem late here, but last week when I recorded the review, Mr. Powell had not yet spoken in Jackson Hole, so his speech was interpreted as hawkish. He did see inflation as too high, warning that they're prepared to raise rates further, so clearly keeping a dovish tilt. Markets are pricing in on the right. You can see that we're pricing in about 50% of a hike by the end of the year. Let's say 50% odds that we have one hike and that's it. And interestingly, in March, markets are starting to price odds of a rate cut, which we think it's a bit too early. So we're not in disagreement that maybe there won't be any more hikes in 2023 or in this cycle, maybe just one. But after that, we think rates will have to stay high for a while, and the accumulated toll should weigh on the macro data. And let's say it another way, to see a cut in early 2024, likely we would have to see the economy deteriorate significantly, which is not what we would call a soft landing scenario. So we think that something should be repriced here eventually, and that rate cut in March might be a bit too optimistic. But a few reasons again why we remain on the careful side. In the US, that 70% of GDP is explained by consumer spending. And consumer spending by the end of this year should shift in a good bit, because here you have two charts. As you can see, they're not from us, but still pretty good stories here. It was a survey done by a US bank showing that the restart of payments for student loans, so the end of the moratorium that was put in place by Mr. Biden in the last few years, means that households will have to start paying off their student debt again, and that's a lot of money in the US. It's about $18 billion per month that will have to come out of the pockets of US households, about $55 billion a quarter. And here you have the distribution on the left, the people that say that they won't be able to repay that, or they will have to change significantly their spending habits. So it's a good chunk, and there's an economic concept here that's important when you look at those with under $50,000 of income. That means that these are the households that have what we call very high marginal propensity to spend or to consume, meaning that they're not saving that much money. So if you're taking money out of their pocket, that means that it will directly impact their consumption spending. Rather, if you ask very rich people to pay off their student debts, or if you change their income, they will likely just save less and spend the same thing. So that's why this can have a direct impact in GDP figures. The dynamics of the GDP in the US will be impacted. Consumption should slow down, and we are expecting that this will likely lead to an abrupt shift in growth in the US, which should be reflected in the data pretty quickly. But on the right, it's another way to look at it, and just to put the economy in action here. It's always interesting to say these things in an economic review. But recently, what was a very strong tailwind for consumer spending was stuff like the Barbenheimer. So Barbie plus Oppenheimer, people went to the movie theater, so we catch that in economic growth. The tours by Taylor Swift and Beyonce, stuff like that happened, that was just pushing consumption patterns recently. In the next few quarters, we see that this impact will be fading, and on top of that, we will be adding the restart of student loan payments, which should force households to change their spending pattern, which should be reflected in economic growth. So all eyes on the consumers moving forward. Economic surprises were stronger in the US this summer. But momentum seems to be shifting here. So the darker blue line on the top right shows that the surprises in the US were the strongest, and this is by city. So they just look at all of the economic data that comes out on a daily basis. They look at the expectations from economists versus reality, and they create this surprise index. Now we're starting to fade. At the same time, we're starting to see a rebound in Europe and China. So that could change risk appetite if we have the surprises in the US fading. That could change some leadership. That could be reflected in the markets at some point, in currency movements also, and FX rates tend to be sensitive to economic surprises. So to be considered, but we're starting to see surprises fading in the US. Finally, U.S. labor market. Today we'll have Canada's labor market data next week, but wage growth is slowing and unemployment is rising. This is seen as positive for the markets today because on the left you see that the monthly gains in wages, in hourly wages, slow from 0.4 to 0.2, meaning that there is less inflationary pressures coming from wage pressure. It's just 1 month. Let's see if the trend is changing here. But this is a development that was well received by the markets, meaning that there's less potential for rate hikes. And on the right, same thing. Unemployment rate, long-term series here, but it seems to has bottom, moving up at 3.8%, meaning that even though we're creating jobs still, because we added 170,000 jobs in the US in August, more people are joining the labor force, which again leads to a less tight labor market, leading to less wage pressures, less inflationary pressures, less of a need to hike some more. So this is what the market is seeing here. So what to watch next week? We'll have the Bank of Canada rate decision, always a very important data point. The jobs report and the unemployment rate in our country. In the US, we'll have the durable goods orders report and also the ISM services index, which should go sideways but above 50, meaning we're still seeing some growth in the services sector there. So that wraps it up for the week. ia.ca/economy. You can find this review, you can find the podcast, you can find us on social media, iagam.ca/insights. You can have our monthly, you can have material from my colleagues at iagam. So lots of options for you. Thank you for following us on a weekly basis. Always a pleasure to serve you, and I'll see you again next week.